Recording in progress.
Good evening, everyone. My name is Wylin, and I'm the Senior Investor Relations Manager for Manulife US REIT. Thank you very much for joining us this evening for our webinar on reimagining office with Manulife US REIT. Today, we have our management team on the call. Allow me to do a quick introduction. First, we have our CEO, Mr. Trip Kant, our Deputy CEO, Ms. Carol Fong, our CIO, Mr. Patrick Brown, and Head of Finance, Mr. Chong Jia Yi. We will be starting with a presentation by our CEO covering our third quarter 2022 operational updates, as well as some insights into the US office sector, which has evolved post-COVID-19, and also our strategy to capture the changing demand. This will be followed by a Q&A session with our management team. So please feel free to type your questions in the chat box and we will address them later. I will now hand it over to Trip for his presentation. Trip, please.
Great. Thanks, Wylin. Thanks, everybody, for joining tonight. I would say it's good to see you, but I can't really see anybody, but we're still glad you're here. So we'll just kind of run through our third quarter operational update. And we're going to start off with a little bit about Manulife US REIT. As you know, Manulife US REIT is sponsored by Manulife, the insurance company. Manulife has about $1 trillion of assets under management. But what a lot of people don't know is they have 95 years of experience in managing and investing in real estate as well. They have a global real estate portfolio of about $20 billion. And over half of this real estate portfolio is made up of office. So we have a lot in common with our sponsor, a lot of synergies and similarities. Since listing in 2016 with 3 properties, we've tripled in AUM from $777 million to $2.2 billion. Our portfolio now is 12 properties, about 5.5 million square feet. And something we're really proud of is that 85% of our properties are certified green. Sustainability is something that's been important to us since the beginning, and it'll continue to be so. On this highlight slide, I'm not going to go through all these points right now. We'll be touching on them in more detail later in the slides. But something I want to point out that, again, we achieved a 5-star rating for GRESB in 2022. This is a real estate sustainability benchmark. And it's something that we're really, really proud to have achieved again. So in terms of our third quarter occupancy, we were slightly down to 88.1% from 90.0% in the second quarter. This was primarily due to one of our larger tenants, Quinn Emanuel, which is a law firm at our 865 Figueroa building in Los Angeles. Quinn Emanuel had 135,000 square feet. Their lease was expiring in 2023, and we were able to secure an early renewal and extension with them. But they did want to give back space. And so the 71,000 square feet of space that we got back at Figueroa was really the bulk of that decline in occupancy in the third quarter. This was offset by a bit of good news at our Diablo asset in Phoenix, Arizona. We acquired this asset in December of 2021 at an 85.7% occupancy. We were just able to sign a 10-year lease with a semiconductor company. And the 25,000 square feet that we were able to sign there brought the occupancy at this property up to 91.1%. Our WALE, or weighted average lease expiration, at 4.9 years has given us a lot of stability. And the 4.3% positive rental reversion that we saw in the third quarter brings our year-to-date rental reversion up to 1.7%. And as you'll see at the chart in the bottom left, our lease expirations are pretty well spread out over time. No big spikes in lease expirations coming in any one year. In terms of our debt maturity, we have one remaining property level loan in our portfolio, which is on our Phipps property in Atlanta. Our finance team is working to secure this refinancing now, and we're hoping to have that closed before the end of the year. And this would be trust level debt that would be replacing this property level debt, which would make 100% of our portfolio unencumbered at that point. Our gearing ratios and our interest coverage are roughly where they were at the second quarter at 42.5% and 3.4 times. Our weighted average interest rate did go up slightly in the third quarter, about 37 basis points. But our fixed rate, the percentage of our portfolio, of our debt portfolio that's fixed rate, remains above our 80% target. Now, moving into the market and what we're seeing in leasing and the conditions of the real estate markets. This is a series of charts that's put together by JLL for us, and they target our specific submarkets. This is not national data. This is data that's very targeted to the submarkets that our properties are located in. And we shared this in the last quarter. We saw mixed signals back then, and we continue to see mixed signals in the third quarter. You'll notice in the top left-hand chart that leasing volumes remain pretty low. We saw a pretty sharp downward trend from the end of 2021 into 22, and it does look like it's flattened out a bit. But the leasing volumes are still really low, and it's a very challenging leasing environment in our submarkets at the moment. If you look at the chart in the bottom left, this shows the concession packages, which are what you have to offer tenants in order to get them to move in. And it really gives you an indication of whether it's a tenant's market or a landlord's market. And obviously, recently, it's been a tenant's market. The free rent is literally that, just the number of months of free rent that you give to a tenant when they move in to incentivize them to sign a lease. This started out even pre-pandemic, it was around 3 months in most of our submarkets. And it's, just edged up continually through 21 and 22. And we're roughly at 4% now. But the trend that we were watching carefully last quarter that we were more concerned with was this 1/TI allowance. And this is tenant improvement allowance. And it's the money that you actually give to tenants when they move in to fit out their space and do construction to build out, their offices. This number, you can see the trend line in that red line. It was really moving up steeply throughout the last half of 21 and into 2022. And a lot of this was attributable to inflation. Inflation of construction materials, labor, but it also showed that tenants were able to negotiate this into their leases. And so we were in the second quarter, we were watching this carefully. We were glad to see in the third quarter that this number has tailed off quite a bit. And we think this is a promising sign because, as you know, inflation has not really eased that much. There are still inflationary pressures on these costs. But what this shows is that tenants are just not getting, or the amount of TIs that the tenants are getting or asking for isn't continuing to increase. So this is a good sign. And this all kind of plays into that chart on the top right, which shows the difference between net effective rents and base rents. So base rents are kind of the face value of the rent, and the net effective rent is what you get after you take out the concessions that you have to offer to a tenant. In the second quarter, we saw those two numbers diverging, and the net effective rents getting lower. And so again, this was a trend that we were happy to see kind of reversing here in the third quarter, and we'll be tracking this into the following quarters to see, if these lines keep coming closer together. The last chart in the bottom right shows subleasing activity, and as you know, subleasing activity can tell you about the health of a leasing market. It can give you some insights into whether tenants are wanting to give up space or pick up space. And we did see that pick up in the third quarter. I want to point out, though, that the subleasing in our portfolio, at our properties, has remained pretty steady, and it's still only at 3.5%, which is pretty low. Another theme that you've probably heard a lot about if you've been reading about office in the US is this flight to quality. And we're certainly seeing that both in our submarkets and actually across the US. And what this is kind of playing itself out to be is that as tenants are moving spaces, and we're seeing a much bigger share of leasing activity being relocations. The converse of that is that renewals are also at historic lows. But JLL research has shown that 95% of the tenants who are relocating are moving to equal or better quality spaces, but they're paying 7.2% more on a per square foot basis in rents. And this is a pretty telling data point for us, because what it shows is that tenants aren't moving to save money. They're moving to have better offices. It means that even though when some of them are downsizing, they're still paying the same amount of rent overall. And what they're really paying for is that more modernized space, having a more productive office. And this shows up in the data here at the bottom, where it shows the vintage of US office stock. And what we see is that the buildings that are newer, the ones that are built since 2010, kind of to today, only make up 12% of the total US office stock, but they take up 28% of the leasing activity. So they're getting way more than their fair share of leasing done. And anecdotally, what we're finding in these older vintages is it's the properties that have been renovated that are able to compete with these newer spaces that are also getting the lion's share of that leasing activity. So what does this mean for us? Well, a lot of our buildings in our portfolio are of those older vintages. And so in order to compete, we have to really make sure that we're repositioning our assets where we need to, in order, and especially in the assets where we feel where we can win, to really compete for this leasing demand. And you've heard us talk before probably about a two-pronged strategy. One is what we're calling hotelization or a modernization of our offices. And the second one is this idea that flexible space is also becoming really in demand from tenants, and the top office buildings that are capturing demand or capturing leasing activity have this in their spaces. And so what we're talking about doing is embarking on this hotelization concept on one of our assets in 2023. And then we've already partnered with JLL on a flexible space solution for one of our assets in New Jersey. And we'll talk about it in more detail, but we've got a little video to show you. It kind of gives you an idea of some of what we're talking about. Great. And so as we're looking through the assets in our portfolio, and we're trying to decide which ones would be good candidates for these kind of improvements, we want to look at the attributes that a building that's a successful candidate for this will have. The first one is really taking a look at the location of the building, the market that it's in. And you're obviously looking for a healthy, diversified economy. You're looking for business sectors that have tailwinds, ongoing growth of leasing demand and potential rent growth. But you're also looking for areas that are vibrant, have this work, live, play type of environment. And you're also looking at properties that have certain physical attributes that are going to make them, good hotelized buildings. You want, outdoor terrace spaces and maybe places that have outdoor spaces that you can activate and make for gathering. You want a sufficient floor plate that's going to be able to accommodate, a critical mass of either flex space or some of these different amenities like, lounges or cafes or gyms. And lastly, you want spaces for public and social events, conference centers, potentially even rooftop bars or gathering spaces like that. But it's important to point out that the majority of the office building is still going to be a traditional office and traditional leases. And what you're seeing also, though, is that tenants who are building out their space are incorporating some of these design fundamentals into the spaces that they make. And they want to be in a building where the common spaces are going to be consistent with the space that they're building. And so those are some of the ideas of what an asset would look like that we would want to do this on. And so this is really why we're selecting Peachtree to kick off this initiative. The plans that we have for Peachtree, begin on the outside, and when you come into the entrance, renovating the lobby areas, the conference center. We're talking about adding some amenities like a coffee bar or a lounge. And Peachtree has those neat little spaces that we talked about where you can create these outdoor terraces and places where people can sit, and either have, little gatherings or just spaces that people really want to be in. We're looking at an estimated project cost of about $18 million over 2 years to do these improvements. And really the main story about Peachtree is Atlanta, the market that it's in. Atlanta is one of the strongest markets in the US. It's a very business-friendly city with a healthy economy. And Midtown Atlanta is really the center of the activity in the city. And our Peachtree asset is right in the middle of Midtown Atlanta as well, right in one of the best locations. Our building is surrounded by lots of good restaurants, hotels, good retail, and a critical mass of residential as well is right there in the area. The population in this area has grown a lot over the last decade. It's a very highly affluent and well-educated population there. And this has really drawn a lot of the top employers to this area. So you've had this really virtuous cycle in Midtown Atlanta that's made it one of the strongest submarkets in the US. And where it all comes down to is that we feel that by making these improvements to Peachtree, we can really capture an upside in rents. Right now, we're getting about $38 per square foot in passing rent at Peachtree. There are similar assets, that are similar vintage that have taken on some of these improvements, and they're getting 30% higher rents. And so really that's our target, is to be able to compete and capture the same rents as these buildings. And here you can see a rendering that kind of shows what I'm talking about. There's, the before picture shows what it looks like now. It's just kind of an unactivated, empty rooftop. And we think that we can create an outdoor terrace like this in space like that. Now, when we talk about flex, we want to keep in mind that flex is really more than just what people have, traditionally associated with co-working. The co-working spaces are certainly a part of it. You want the places where individuals can sit, have a workspace for the day, where your digital nomads can come and hang out in this co-working space. So that's going to be a component of it. But we're also going to have a wider spectrum of offerings in our flex product, ranging from this co-working space to smaller meeting rooms where a small team or a team that needs a private office can meet, all the way up to team suites, what we call spec suites. That a small company who's just looking for turnkey space can move right into. And what this really gives us is the ability not only to control our own space, but really to control the relationship with tenants, because it works two ways. Small tenants that tend to grow through this might become permanent tenants in your building, and tenants that are in your building now that are looking for a flex space solution as part of their permanent office, a workplace solution. Can stay in your building. You can re-sign them, extend them, and give them the kind of products that they need to have their workspace. And so just really this direct relationship with the tenants is an important component of this for us, in addition to getting higher rents. So we're kicking this off. You may have seen in the press that we've announced a partnership with Flex by JLL. We have gone ahead and commissioned the first phase of this work. Signed the agreement with JLL Flex, and we do have options for phases 2 and 3. And the estimated cost of all 3 phases would be $6.8 million. And we'd be kicking this off in 2023 and hopefully having a finished product to show, by the end of the year. So now taking a step back to the macroeconomic conditions and some of the things that are impacting real estate. The U.S. economy rebounded a bit in the third quarter after 2 quarters of kind of contraction. Unemployment is still low, but the thing that's on everybody's mind is still inflation. It's still the headline. It's still what's causing people a lot of anxiety. And the rate hikes, the interest rate hikes that the Fed is using to combat this inflation. The announcements that came out earlier, they continue, and we think they're going to continue through the fourth quarter. And really what this has done is placed a chill, if you will, on the real estate market. Lenders are more reluctant or are underwriting things. It's more difficult to get debt, and that debt is more expensive. But really, it's the effects on business and our office tenants, I think, that we're paying close attention to as well. And just how that's going to impact what they need in terms of workspace, and how that'll impact our leasing activity. And so given these headwinds and all this, continued uncertainty, what do? We've got to keep moving. We can't just sit and wait. And so we're talking about the 3 R's. And for us, the 3 R's mean reposition, recycle, and rejuvenate. We've told you a little bit about the repositioning. We want to hotelize, certain buildings in our portfolio, and really work to provide, a flexible office product in our buildings. But we're also, we think it's time to begin looking at recycling, disposing of some assets. And we started this process in the second quarter. And our top priority in the short term is really using these proceeds to manage gearing. Having a balance sheet that gives us flexibility moving into the future is really a priority for us. And so we're looking at starting that process. And we think this is really a key component of what we need to do. In addition, we're talking about rejuvenate. Now, rejuvenate is kind of a higher, more strategic level concept. But 6 years after IPO, what's next for us? So we formed a strategic working group made up of our board, people on our management team, and representatives of our sponsor, to really begin looking at opportunities, both on the kind of businesses that we want to be in terms of the asset classes. We talked last year when we bought these 3 assets in December of last year about a pivot from high-rise office buildings into more of a low-rise product. And so we want to continue to explore how we might be able to pivot our real estate strategy to really give us better growth prospects going forward. And we're going to have this strategic working group really considering in earnest strategic partnerships, potential joint ventures and mergers and acquisitions. So, we hope to have a lot to tell you about in the coming months. We feel invigorated, but we're really looking for ways to continue to grow, and we're looking forward to keeping you posted. So stay tuned. Thank you.
Thank you very much, Trip. Now let's proceed with the Q&A session. So if you have any questions for the management team, please type in your questions in the chat box and we'll take them. I think we do have one question to start off. This participant says, I like to work from home. Is office still relevant? Maybe Trip, you take that?
Yeah, no, I'll take a crack at that. We all like to work from home. I think everybody likes to work from home. But the office is still absolutely relevant because there is some work that you can do at home that you can be more productive in for sure. But what we're seeing with our office tenants in particular is that even the ones who are the most forward thinking realize that the office still is going to have a place. And the kind of things and the kind of events and the kind of activities that happen in an office may change. But having an office is going to continue to be an important component of building corporate culture, of having good collaboration. There are certain things. It's much easier to onboard new employees in person in a space, and so we do believe that the office is going to remain relevant. And we really think that the tenants who are in front of this, some of the designs that we see are really innovative in terms of offices. And what we're seeing is that a lot of times they need the same amount of space that they needed before. It's just how that space is being used is different. So I think that we're firm believers that going forward, the office is not going away. It is still relevant. It's just how it's going to be used could be different.
Okay, still waiting for questions to come in. Once again, if you have any questions for management, please type it into the chat box. Okay, I think we have a question on, maybe let's touch on gearing. Yeah, this person says gearing is very high. Should we be worried? Maybe Jia, you can take this question.
Yeah, all right. Thank you for the questions. Yeah, on our gearing wise, I mean, based on the third quarter gearing ratio is at 42.5%. This is well within the MAS requirements of 50% gearing limit, right? We are still comfortable with the gearing level of below 45%. This means that there is still a headroom of about 105 million before reaching the 45% comfortable level that we have. We will still continue to be prudent in minimizing our expenses, deferring our non-essential capex, as well as invest in value-added tenant improvement and leasing costs to secure leases. Right. So to give a context on the headroom before reaching the MAS gearing limit of 50%, the valuation will need to drop by another 16%. Right. Given that our third quarter 2022 interest coverage ratio ICR 3.4 times, we are still accorded a 50% gearing limit by MAS, such that we still have the headroom of about 25% drop in earnings or 35% increase in interest expense before falling to 2.5 times of the ICR. However, in the event that our ICR falls below 2.5 times, MAS gearing limit will be reduced to 45%. However, the comfort is that we still have 81.1% of our loan interest, which is fixed as at this third quarter. So therefore, this has weathered against most of the impact from interest rate rising currently. So regardless of the headroom which we have, management is still exploring opportunities for these positions or potentially activate the distribution reinvestment program to prevent gearing and ICR becoming an issue.
All right, thank you, Jia Yi. Once again, please keep your questions coming in. We have a question on occupancy. Occupancy seems to be declining. What are you doing to address this? Pat, would you like to take that? Pat, you
Can you
are.
hear me?
Yes.
Can you hear me now? Yeah. So that's top of our mind. We declined to 88.1%, as the slides point out, and that's not a level that we want to, that we're not comfortable with. So we're trying to drive this as high as we possibly can, and we're taking a number of actions. Trip highlighted a few of them to be proactive, things like hotelizing assets and working with flex leasing providers. And what I could say is that at the moment, we're actively engaged with a wide variety of tenants at a number of our buildings to try to lease space, new space. We've got nearly 500,000 square feet of lease proposals in our pipeline at the moment. And there's no guarantee that we get to the finish line with any of them, but these are big numbers, and we're proactively working with many tenants. And so hopefully later this year or within the first half of 2023, we'll have some success and we'll be able to report that back to you, and occupancy will start moving back up. So this is top of mind, and we're very cognizant of it. So we're working on it, and hopefully we'll have better news in the coming months.
Thanks, Pat. The next question is on hotelization. How do you see the success of hotelization for some of your office buildings? Trip?
Yeah, I mean, I think the simplest way to put it is that we would see higher rents and higher occupancy. The entire basis of wanting to do this is to drive those two things. And what we're seeing, and again at Peachtree, is that the buildings that do this do have, higher rents and higher occupancy. So that's really the fundamental reason we're doing it. I think as we're selecting assets, that are candidates for this, we went through the attributes in terms of location, in terms of, the physical attributes of the buildings. And so we're going to continue to analyze that. And the market conditions are also an important part of this. As we mentioned, Midtown Atlanta, is really still in a growth stage, and still has a lot of upside. So it makes sense there. And I think that in addition to the physical attributes and the location, you also have to look at the current market conditions in a place to where you can get that rental growth. But it really is all about rental growth, occupancy, and driving valuations.
Thanks, Trip. The next question is on our share price. Why has the share price fallen so much? Carol, would you like to take that?
Yeah, sure. No, I think that's actually the number one question on everyone's mind. If I may, especially for unit holders. So, if I may share, the last couple of months has actually been quite bad for my heart. I think I got a few heart attacks. My heart stopped beating a few times. If you look at how share price has been trading, we went to a low of 31 cents. On a normal day, sometimes we are up or down like 5 to 9%. So what has really happened, I think, is that if you look at the uncertainty in the world, there's the rate hikes, there's the work from home issue. It doesn't give investors comfort. A lot of the index funds and also the ETFs have actually been trading and selling. So I think the comforting thing is we do our share analysis once a quarter, and the last one that came in showing the early October, mid-October's numbers. Our insti base and our retail base has not changed. So we are still 50% institutional base, which is what it means. Basically, the shares are held by institutional investors, and 50% are still retail. Because I was really quite worried that our investor base would have changed quite significantly. So for those of you who have been with us longer, when we first IPO, 80% of our investor base were actually retail. So we changed that in 2019, 2020 to make it more diversified. And we have managed to hold it at about 50-50. And one more thing, if you look at, I think, across the US REITs listed in Singapore, I think there's about six or so US REITs listed in Singapore. Year to date, the performance has also been about 40+% down year to date. Office REITs itself, there's 3 of us. We have been trending around that range. So on a normal day, we sometimes are a bit more volatile because among the 3, we are larger in terms of market cap and more importantly, free float. So our free float is 91%. So what that means, our trading volume is also higher. What it means, it gives opportunity to all the index funds, ETFs, even the hedge funds to treat us more than our peers. That's not an excuse, but I just noticed that because we have quite a bit of volume trading liquidity going on. So that is actually sometimes a two-edged sword, it's good and sometimes it may not be good. So if you look across the US, what's happening in the US REITs year to date are also down about close to 40%. So we are kind of like quite aligned, I would say, with how the US REITs have been performing. FTSE REITs have actually performed much better. So that's one phenomenon itself that we are seeing. What we are looking at, what we are doing is, we can't control the stock market. We can't do things that we have no control. But I think it didn't help. I think recently there was also articles, rumors that our tax will be, investors will be taxed 10% starting from 1st January 2023. So there was actually a report out by Credit Suisse, letter that went out to unit holders, to their shareholders, the PB side, and saying that Credit Suisse will no longer actually be holding PTP entities, which includes the US REIT. But how we have been structured and how the US REITs have been structured, we are actually excluded. So we did put out a clarification announcement about 2 weeks back to address that. So subsequently, I think a couple of the US REITs have also put out that. So in all this, there's so much things happening. I think the last thing we need was rumors, and we have also heard from investors, our PB investors, that they have been advised wrongly by Credit Suisse that they should actually divest of their stocks because of the 10%. So there's a lot of things happening, which is why I think it's timely that we can reach out to all of you. I hear there's about 7,000 of you tuning in, so thank you for your time. we hope to give you as much color and update as possible, and feel free to reach out to the IR team if you need more color on anything. Thank you.
Thanks, Carol. The next question we have is, why don't you convert some buildings to life science buildings? Interesting question. Pat, would you like to take that?
Yeah, sure. It's a great question, and obviously there's been a lot of headlines in the U.S. over the last, I would say, 2 years, but life science has really been sort of a pretty emerging sector in the U.S. for the last 5 or 10. And we've looked at a number of options at all of our buildings for all sorts of uses, life sciences including, to try to generate value. And with life sciences, where you have to be, what you have to understand is that life sciences pop up in clusters. You can't just, take a building in, I'll use Sacramento as an example and convert a portion of it to life sciences, because there simply may be no life science tenants there. Because as I said, they pop up in clusters like San Diego and Cambridge, and which is outside of Boston, and a couple other select markets where they're really, really prevalent. So one thing is you have to be in the right market to capture life science demand. And the second thing is that, they have very unique fit out requirements that you can't adapt to traditional high-rise office buildings. What I will say is that some of our more recent purchases, the Project Trio that we acquired late last year, December 2021, I believe we closed down. It was 3 buildings, 2 in Phoenix and 1 outside Portland, has some of these features that are more conducive to doing things like life sciences. And for instance, the tenant that was flagged to you at Diablo that we signed just recently is not life sciences, but they're doing similar type manufacturing and R&D work in our building at Diablo. And I think we made that acquisition because we realized there was high-tech tenants in this market, and that the building was conducive to meeting the needs that high-tech tenants want to do their R&D, life science type work. So we've had success there. And similarly, that's the situation at our Tannisport buildings. One of our tenants in that building is Tokyo Electron, who does semiconductor work and does R&D on site. So we do have some of that exposure, like life science, like in our portfolio, and we're hoping to grow it. But it's also important to understand that you can't just convert, high-rise buildings in markets where life science tenants don't exist into life science opportunities. It's something we're studying hard, and we're hopeful to grow our footprint in that space or our exposure to that space as we continue to look to grow the portfolio.
Thanks, Pat. The next question we have, how do you see MAST compared to your peers in terms of emerging stronger post-COVID-19? Carol, take that. Yeah.
Thanks, Mylene. I think that's a great question. I think now that we are 6 years old, we've been listed since 2016. The world has obviously changed. When we first got listed, we are trophy and class A, and we have that across the portfolio. But last year, I think especially during COVID, we do realize that we need to pivot a little bit into the growth sectors that we don't really have that much. So 40% of our tenants are legal and finance institutions, and most of our tenants are HQ listed companies, government agencies. So what that has created is a very core, strong foundation of tenants. But obviously during COVID, these are not the tenants who were willing to pay. They were not really back at work. And we saw that the upside actually and the growth came from the growth tenants that, that I think we didn't really have. But having started a base of class A trophy assets of that, we could then convert some of, we can pivot into the sectors, high growth markets that we did last year, because we started from a stronger, I would say, like a more high quality asset. So for our peers, if you don't have that to start off with, it will be harder for you to get a class A or even a trophy, which is a bit bigger, newer, and in terms of yields, they are actually lower. So that's one thing that we have seen how we have pivoted. But if you look at the investor base itself, among, I think, our peers, I would say that we are still the most institutionalized REIT, which means that 50% of our investor base are institutional investors. So these are investors that we can engage, we can explain, we can reach out to and share the fundamentals and what's happening. And we are also at that point, I think, TripShare, that we are doing an internal review to look at what's next for us. So we are talking to different people. We are looking at strategic partners. We have a very strong sponsor, Manulife, who owns us 100%. So we have Manulife, who has 36,000 employees in the world, 1 trillion AUM. So at any point in time, I think we need to do anything, the sponsor will be behind us. So how to stay relevant and ahead? I mean, of course, which is what we are doing right now, the flex and hotelization strategy, I would say. So make sure that we stay ahead, we pivot. And then the last question, I mean, I will just leave it with all of you is, we are also at a point whereby do we need to be 100% office REIT? So, I mean, those are all the things that we've been considering. And when we do move or pivot, I think we'll do it in quite a straight way.
Thanks, Carol. The next question is on interest rates. The Fed raised rates again last night, as everyone knows. So how much more is interest rates going to rise? Because every time, the Fed raises rates, the S-REITs share prices just keep falling. So can MAST survive, and what's the impact? So I think this question would be for Jia Yi.
Okay, thank you for the questions. It's true that this morning the US Federal Reserve has just increased the rate by 75 basis points. But the thing is that the comfort is that because the Federal has also signaled that they are going to reduce the size of the next interest rate in December. But in terms of the terminal rate, they are expecting it to be increase as compared against the previous expectation. Right? So all in all, the Fed is expecting to increase the interest rate to probably 5% next year to fight against the inflation. Hopefully, this will bring the inflation down from the current 8.2% to their target level of 2%. Right? So, and when that happens, rates should be tapered down to short the economy. And hopefully, by then the world goes back to a normal interest rate regime, which is more sustainable in the long term. Right? But just bear in mind that currently, what we have in place is that we have 81.1% of our interest rate, which has been fixed in the third quarter. Right? With that also we have a weighted average of 3.34% of weighted average interest rate. So if you look at the current rate right now, all in basis, we might be looking at the 6% all in interest rate for us. But since we have this 81.1% fixed rate, and also our weighted average of 3.34% right now, so you can weather most part of the increase in the interest rate rising.
Thanks, Jia Yi. The next question, probably also for Jia Yi, is the dividend payout, will it be reduced in the next, I would think it's next 2 to 3 years?
Okay, because since the IPO until now, 2016 until now, we have been paying 100% of our distributable income, even though our trustee, in fact, has allowed us to distribute at least 90% of the distributable income. So we hope that to maintain that ratio in order to preserve the distribution yield to the unit holders. Right? So we can continue to monitor about this, and yeah.
Thanks, Jia Yi. We don't see any more questions coming in. Just give it a minute or so. Please type in your questions if you have any more questions for us. Okay, I think there is one more that just came in. Are you going to buy anything else more than office? Will you consider diversifying your asset class? And what are your acquisition plans? I think that one will be for Trip.
Yeah. So, as I mentioned in my presentation, we're looking at all of our options right now. I think that we started a bit of a pivot last year when we bought the 3 assets, that are different than our high-rise Class A office buildings. And so I think that as we're looking at the future and how we can grow or what kind of properties we can have in our portfolio, we want things that are going to diversify the risk of our portfolio and be complementary to what we have. And I think that, going forward, we've all recognized that one of the things about Class A office is that it's going to require a lot more CapEx, just improvements. And we talked about hotelization and those kind of efforts. But perhaps, we could consider property types that have less of a CapEx burden on them in order to complement that strategy. So I think that we're open to all the ideas, and that's what this strategic working group has been put together to really take a look at. We're working with different groups to take a look at strategies, what opportunities might be available in the market, where cap rates are going on different kind of asset classes. And I think that I was trying to read the second part of the question.
Your acquisition plans.
Acquisition plans. Well, look, in the short term, with our share price where it is right now, it doesn't make a lot of sense for us to raise equity because the cost of that capital is just going to be too high to buy accretive assets right now. But I do think that when we talk about recycling, the proceeds that we have left after we've, again, maintained our focus on trying to maintain our gearing, would be that would be our acquisition plans. The money available for that would come from a recycling where we would, dispose of certain assets and pick up assets that, perhaps would be of a different character.
Thanks, Trip. I think we have got one more question here from Young Investor. Any plans for merger with other US office REITs? Trip?
Well, we don't have any plans. No, there are no plans to merger with another US office REIT. There aren't many of those. So, those opportunities are not out there. But I do think that, again, as I mentioned, our strategic working group is open to all kinds of considerations. We are open to those ideas, to mergers, acquisitions, joint ventures. Strategic partnerships are really going to be, a key focus for us and what we want to analyze in the coming quarter. So while we don't have any plans right now, we are open to ideas.
Thanks, Trip. I'll just wait for a couple of seconds to see if there are any more questions. Oh, okay, another one just came in. Are you satisfied with your current size? Do you plan to merge with other? Okay, the second question is similar.
Yeah, and Carol, maybe you can take that one, talking about the size and the advantages of that.
Yeah, I think it's about similar to what Trip shared. I think when we have strategic, internal review, anything is up on the table. Like I shared, we are 6 years old. So we are looking at how we can, I would say, transform. And if you ask me, because of our size, I would say size matters. Size matters, but we will not grow for the sake of growing. When you are bigger, your debt headroom is higher. When we raise equity, my 20% mandate to raise equity is bigger if my market cap is bigger. I don't have to do my my EGM to get certain approvals if I want to make certain kind of acquisitions or even divestments. So I think it does matter. And of course, most importantly, I will be able to attract a different kind of investor base. Some of the bigger funds would come in and that could help support the share price in times of need. So a lot of pros, I would say. So which is why if you look at even the Singapore landscape, right? If the biggest, largest REIT have merged, then do you think size matters? Right. Thank you.
Thank you, Carol. The next question is on gearing. What is the gearing level that you are comfortable with? And what level do you think is the optimal gearing level? Jia-Yi?
Yeah, I think earlier I mentioned that, the same thing, right? Because right now we are at 42.5%, which is where we did the 50% gearing limit by MAS. So we are comfortable as long as this is below 45%. So as long as there's a debt headroom of 105 million before reaching the 45% gearing limit.
Thanks, Jia-Yi. Okay, I think we don't have any further questions. So I just want to thank everyone for joining us today, this evening. And also a big thank you to Tiger Brokers for giving us this opportunity to share about our business and our strategy. So have a good evening, everyone. If you have any follow-up questions, please do not hesitate to reach out to the IR team. Our contact email is on the website at manoliveusreit.sg. So have a good evening, everyone. Thanks and goodbye.
Thank you, everybody.
Thanks, everybody.
All right, bye.
Thank you.
Recording in progress.